Good afternoon. Thank you so much to the Association for having us here today. Really excited to talk about strategies within commodities in a world of high inflation and slowing global growth. I could just give you a quick run through of the presentation today. I want to give you an overview of where we are in the commodity markets. They're a market that is very interesting at the moment and there's a lot going on. We want to spend some time talking about the role of commodities in a diversified investment portfolio, some of the traditional reasons that investors might look to include a small allocation to commodities, but also look at some of the thematic opportunities in commodity markets that have presented themselves over the last couple of years and more so even over the last 12 months. I want to give you an idea of the type of content and educational material that S&P Dow Jones Indices has available in the space. And then on to the really exciting part of the presentation. I have my wonderful industry colleague here, Kriskey, and we're going to have a fireside chat about commodity markets and how investors can use them. So what's happened in commodity markets? Well, even if you don't invest in commodity markets individually, it would be hard to ignore what we've seen in some of these markets over the last 12 or 18 months. On the screen here, you can see the performance of 24 of the major individual commodities that make up the S&P GSCI, which is a benchmark index, production-weighted index that provides, a transparent way to look at the performance of the commodity markets. And on the slide here, you can see, the massive outperformance of natural gas. We are in the midst of a global energy crisis, and particularly I'm here in London today, particularly in Europe and in the United Kingdom, an enormous focus on what's happening in the energy markets, but that is also flowed through, to the broader petroleum complex as well. The other big performers so far this year have been the agricultural commodities. Again, a function of the conflict that we see in Ukraine, and some production-related issues. The laggards have interestingly been the industrial metals, although post the pandemic, they did have a very good run higher. We've seen some weakness there, largely a factor of some concerns over growth levels in China, and also more broadly over the state of the global economy. But really interesting to look at how commodities have behaved year to date and just the dispersion of the individual commodity performance. So let's drill into what commodities might look like in an investor's portfolio. And you can see on the left-hand side, I've got a chart that again shows different asset class performance year to date. And the clear outperformer has been the commodity markets. And on the right-hand side, what we've done is really a very simple analysis of what portfolio returns might look like with a very traditional 60% equity, 40% bond, and then by adding a small, in this case, 10% allocation to commodities. Now, the outperformance of adding commodities is not enormous, but it's certainly valuable, and it's valuable during the type of economic conditions that we've seen today. And again, there is a long and a large amount of academic research that shows there is an advantage of adding a small allocation to commodities over a longer period of time. And I want to now talk about the two reasons that you may, as investors, look to include commodities in a portfolio. The first one is around inflation protection, and we know inflation is a massive issue for us as consumers, but also as investors. And here, the chart I'm showing you shows the US inflation rate against the performance of the S&P GSCI, again, the major benchmark for commodity market performance. And what we know about commodities is that they have a very high inflation beta. So their responsiveness to inflation is very, very high. And you can see, particularly since the start of the pandemic, that strong correlation between the performance of commodity markets and the inflation rate. In a lot of cases, commodities are the cause of inflation. In other cases, they also reflect inflation in a sort of secondary sense, where the inflation forces them higher. So it can be a bit of a circular situation. But clearly, long-held research that shows that commodities are very sensitive to inflation. It's one of the reasons that an investor may choose to hold them in their portfolio. And the second reason is for diversification. When we look at the correlation of monthly asset returns, when we compare the correlation of commodities to equities, to bonds, even to gold as a separate asset, we can see that it's either negative or relatively low. And the other important thing that sometimes we forget is that what we refer to as the cross-commodity correlation can be quite low. I like to say that there is that corn, copper and cocoa have very little in common. And so we know that commodities within themselves have a low correlation, and that can also add diversification in certain circumstances to a portfolio. Again, we're moving quite quickly through these slides, and I really want to get to have a chat with Kathy. But before we do that, I just wanted to highlight a couple of other thematics that may be interesting for someone looking to invest in the commodity markets. We've seen, I guess, on everyone's mind, the idea of the energy transition, the need for us to move towards net zero. We see how that's being adopted in equity markets, even in fixed income markets, to show you that there's also opportunities to adopt these themes in the commodity markets. At S&P Dow Jones Indices, we recently launched an electric vehicle metals index, which reflects the overall makeup of an electric vehicle. So how much of a metal is used in the electric vehicle is how the index is weighted. And we know that the switch from ICE to electric vehicles is one of the most visible and fastest moving decarbonisation themes in the global economy. And this index really allows market participants to really directly access that return profile. So you can certainly access that return profile by investing in companies that are involved in electric vehicles or involved in the mining and production of the metals that are used in electric vehicles. But what you can do, if you can also invest directly in the underlying commodity, and that was our thought process with developing this index. And at S&P, we had the great luxury of being able to use one of our sister companies to develop that underlying weighting system. So the energy transition is one key theme, and I'm going to be really interested to talk to Kathy a bit more about that. And another one is the development of physical carbon markets. So looking at the derivatives markets that have developed to represent the carbon pricing markets. And again, at S&P Dow Jones Indices, we've built a number of different, transparent indices that reflect the performance of both the compliance and the voluntary carbon markets. And investors may choose to invest directly in the price of carbon. They may choose to use carbon-based pricing instruments to hedge their carbon exposure as an addition to a broader commodity exposure, or as I said, by itself. So again, we traditionally have looked at commodities in terms of the value they add to a portfolio from the fact of being sensitive to inflation, or offering some diversification, both of which in the current circumstances are very important. But more recently, we've really seen the growth in thematic opportunities to be involved in commodities. The key ones of those being around decarbonisation, the correct pricing of carbon in the global economy, and the energy transition. So before we get to our chat, I wanted to also just highlight, the large amount of information that's available to investors looking to learn more about commodities, how they might choose to use commodities in their portfolio. And I would really encourage you to look at our website and find that information. So I'll now move to our discussion, and as I said, I'm thrilled to have my industry colleague and friend Kriskey here to talk about the commodity markets. As you heard in the introduction, Kathy is a product strategist with INVESCO, which is a wonderfully long and varied history in the commodity markets. And I'm very, very excited to have her here today. So Kathy, lovely to see you. Thank you so much for being with us today.
Thank you so much, Fiona, for having me. I'm so glad to be here.
If I could start maybe with a focus on Mexican investors. We know that Mexico is both a big producer of commodities and also a consumer of commodities, as we all are. But how should Mexican investors specifically think about commodities from that perspective? Because in some cases they'll be looking at it as a hedging mechanism, and in other cases as a direct investment opportunity. So really be keen to understand, how you think those two different uses can be thought about from the perspective of the Mexican investor.
Yeah, that's a great question, because as you mentioned, Mexico is one of the largest natural resource producers, right? Think about the commodities that come out of Mexico. You have crude oil, refined products, gold, copper, silver, corn, wheat, and coffee, right? So I think that, and that is wonderful from both a hedging perspective and an investor perspective, because there's inherent knowledge there, right? But I would argue that for some investors, even though people in Mexico would feel that they're very comfortable understanding these commodities, from an investor perspective, a lot has to go around education, to do things like listening to Fiona and all those resources Fiona just put up as well. But it is really important, because obviously if your income is related to these commodities, you can sell them, right? So you can sell these commodity products to lock in some of the gains, right? Especially when the commodities are higher, right? Sell when they're high. But for investors, right, there's a lot of, and Fiona mentioned the two main reasons, right? The big motivation for looking at commodities is to hedge inflation and for diversification. And I would argue most recently with the war in Ukraine for geopolitical diversification as well. And that's what I think is important, right? To truly drill down into, why do people use these commodities? Because they are very efficient hedges for inflation, and they really do work as a diversifier.
Yeah, that's great. Thank you for that. If we switch a little bit, I'm sure participants would be interested in getting some background from you, Kathy, on how investors outside of Mexico use commodities in their portfolio, the investors you talk to every day.
Right. And as Fiona mentioned, this has been quite an amazing year for commodities, right? She mentioned 18 months. And so last year, commodities were the best performing asset class. So last year here at Invesco, I had some days between 6 and 8 calls a day. In 1 week, because of all these webcasts and everything, I spoke to 1,800 people about commodities. So there's been an explosion in the interest in this asset class, because before this, for 10 years, right, we had very low inflation. And so really investors didn't need commodities in their portfolio. portfolio that worked still as a diversification, but to inflation hedge, it wasn't needed. So we've seen this massive growth up in, but the important thing to understand about commodities is, one, they're volatile, and two, that you don't need a lot of commodities in terms of weighting to have an efficient and effective hedge for inflation. So we did the math here at Invesco, and the math works out to basically like an 8.2% allocation to like a production weighted index covers 100% of your inflation risk. And so, but I would always argue with clients, like, you don't even need that 8.2%. You probably need something around 5%. So that's what last year we spoke to so many investors that put in that 5%. And then we had the month of January 2022, where all of a sudden every asset class lost money except for commodities. We were the only positive return asset class in the month of January. And all of a sudden, every investor woke up to the diversification benefits. It's my entire portfolio is getting slammed. How do I protect against this? Well, I looked to commodities. And then we had February 24th when Russia invaded Ukraine, right? So that involved two very large natural resource countries, right? And one of my colleagues at RBC said it so perfectly. She said, Russia was the 11th largest economy in the world, and they're done. So to remove Russia from this world of commodity trading and commodity investment, again, has been very challenging. So again, we will still be getting commodities from Russia, but this isolation of Russia has really affected prices. So, and that's why I'd argue that third box. So we have that first box, inflation, second box, diversification, third box, geopolitical hedge, right? And again, the future, we do not know the future for the geopolitical landscape, but commodities are very key to understanding them and to using them as hedges when we have issues there geopolitically.
And I think that's a very valid point to make. We can't know what the geopolitical landscape will look like going forward, but based on history, we know that there will always be geopolitical issues affecting commodity markets, and often it's the commodity market that gets affected first before some of the other asset classes. So even for those investors that maybe aren't directly exposed to commodities, we would argue that you still need to understand how those markets work, and to really think about all those interactions. I've written a question down here, Kathy, that was based on something you mentioned to me when we were talking actually a couple of weeks ago, and I want to drill down into one specific commodity, if that's okay, and it's one that is probably behaving as the king of commodities today, and that's natural gas. I heard you refer to natural gas as a domino commodity, which I thought was a fantastic phrase, but I wondered if you could expand on what you mean by that.
Right, but I think that a lot of investors have not paid attention to natural gas because everyone focuses on crude and gold, right? I think the average person understands like the price of crude, the price of gold, but natural gas has, in the US, it used to be just a domestic market, and now it has become part of the global market as we have in the US exported LNG, liquefied natural gas. So natural gas goes into everything. And that's what I think the average person doesn't understand. So natural gas is used if we look in the grain sector, right? And also, obviously Mexico with corn and wheat, the natural gas is used for fertilizer, right? And so because it's used for fertilizer has gone up exponentially in the past few months, but it's been going on since the end of last year. But obviously, when the European Union came together and banned Russian barrels, which starts December 5th, the banning of those barrels, but they're also banning the refined products as of February. And what did Russia do? They started limiting the natural gas that goes into Europe, right? So that has caused natural gas prices to skyrocket. So it's had this knock-on effect to initially, right, the grains for the cost of the fertilizer, but also in the industrial metals. Now, when Fiona showed you the breakdown of the year-to-date performance, we've seen industrial metals get crushed. And as she alluded to, that is largely due to the China lockdowns, right? The lack of demand from building in China has caused a lot of these industrial metals to trade down. But natural gas is used in the smelting process. And one stat I love is that if the aluminum industry were a country, it would be the 5th largest user of power in the world. So that's what it takes, that much power to go from alumina to aluminum, right? And this smelting process is also pollutive. So a lot of these countries that are trying to limit the cost that goes into the power to smelt these, as well as limit the pollution, are curtailing or shutting down these smelters, right? And as Fiona alluded to, in part of the energy transition, we really need aluminum and nickel in this process to build, the EVs, the infrastructure build out. It's very important. So these commodities are coming under pressure now as we see these curtailments and the shutdown of these smelters. But also, I thought it was very interesting, refiners use natural gas in the refining process. So again, natural gas is an important commodity to watch. In the past 2 years, it's gone up 1,400% in Europe. So we look at Brent crude. Brent crude is one of the cheapest hydrocarbons now. It is cheaper than coal and natural gas. So again, I think that with prices going up for commodities earlier last year and earlier this year, a lot of people thought it was just a crude story, but natural gas is really the one to watch.
Yes, I don't think many of us that look at the commodity markets every day maybe thought we could see moves like that in natural gas, and the impact, as you say, that it has across the commodity complex. That leads me to another question, Kathy, which is about sort of decarbonisation and the energy transition, which we know are upon us. And I think to some investors, they don't see commodities and energy transition as sort of natural bedfellows. But I wanted to get your take on that. What does decarbonisation and a move to net zero mean for commodity markets, but also for investors interested in commodity markets?
Well, I think this is a very important topic because you're right, it is upon us. But the average investor does not understand, and they assume that this energy transition is bad for commodities. Now, it might be bad for some commodity companies, but it's actually bullish commodity prices. And you look to fossil fuels first, right? So we have those 3 sectors: energy, metals, and ags. In energy first, fossil fuels are like the feel-bad investment right now, right? People are shifting away from investing in carbon-based companies because we are part of this energy transition. And we've looked, and it's been happening over the past 10 years, but we've looked at the numbers, and a lot of that money is shifting to more low-carbon, ESG-focused companies. So this sector is not getting those investment dollars. And one of my colleagues did this great piece, and it was called the triple deficit in energy: low inventories, low spare capacity, and low investment. And it's that last one, that low investment, that is really we've seen over the past 10 years, but is continuing into the future. And that is what is causing these prices to go higher long term, right? So as you invest less in the infrastructure in an industry, the thing that you're actually producing gets more expensive. And then just industrial metals, right? They are a very important part of this energy transition, specifically copper. There's 4 times as much copper in an electric vehicle than in ICE, an internal combustion engine, right? And all the grids that need to be built out, the charging stations, right? That is very important to the copper story. So that is a very good long-term story for copper. And again, we need China to reopen, but we think that these industrial metals will rebound as China reopens and as we move in this energy transition. Alli, zinc, nickel, they're all important to the energy transition. And lastly, with the grains, so climate change has wreaked havoc on some of the planning that farmers can do, right? So climate change, we're having these, and we're seeing it now, right? All over the world, the floods in Pakistan, the droughts in China. 2 different sections of China had droughts and 1 had floods, right? In Europe, the massive droughts. I think that France had said they haven't had this hot weather in 500 years, right? So this is very impactful for the grains. And then just as we move in that energy transition, we're going to be blending more ethanol. What do you use in ethanol? Sugar and corn, and also biodiesel. That's soybeans, right? So again, all 3 sectors will be part of this energy transition. And I do think that that is one of the reasons why investors might want to look to own commodities longer term.
Great, thanks, Kathy. I think one other interesting point to add is that I'm sure Kathy would agree with me. We expect to see the development of new investable commodity markets as well, whether that be battery metals markets, which lithium markets like cobalt, carbon markets, which I spoke briefly about. But we'll see new commodities that become necessary or become more necessary during the energy transition. And at the moment, it may be, relatively difficult from a liquidity perspective for an investor to be involved in those. But that's something that we expect will change over time. And in places like Europe, we've already seen, particular interest in investing in renewable power markets. As we said, the development of the carbon markets, which we expect to expand into different geographies. So the energy transition, we think, will also create new market opportunities for investors to have that direct involvement in the underlying commodity. We've got now some questions, so I'll kick those off. Maybe I'll answer the first one just to give Kathy a break. I've had a question, I'm going to ask Kathy to comment on it after me, that says, how do investors think about commodities in the context of their recent strong performance? I guess maybe they're saying sort of, our investors, are we too late to be involved in commodity markets? So I'll start and then I'll hand it over to Kathy for her views. My comment would be that over very long periods of time, as you would have seen in the presentation, that there is a long-standing benefit of holding commodities in a portfolio. We can't know how commodities will perform going forward, but Kathy's given us a really good run through of some of the themes that are involved, that are running behind the commodity markets today. So while, as I said, we can't know what's going to happen to markets going forward, we can certainly look at history to show that having that small allocation has been beneficial during periods certainly of high inflation, and also that diversification benefit, and that there are key themes for commodities today. Now, whether they are across the board or whether they need to be sort of, are there winners and losers, as Kathy talked about, that may be the case. So the way investors look to invest in commodities is really important. And I would say the other comment to make is that it sometimes can be difficult to get all of the benefit of commodities in a portfolio once the market has started to move. Historically, or not historically, but as a rule, commodities are not anticipatory assets. They reflect performance and underlying supply and demand today. So that contemporaneous relationship means that investors really need to think about holding at least a small allocation to commodities all of the time. Now, that has been a relatively difficult proposition when you look back, over a 15-year period, say prior to the pandemic, but the recent performance has made up for that. So, Kathy, what would you add to that?
Well, I have a hard time with the concept of a super cycle, right? We've seen super cycles in the past, but I get that question every single day. Like, are we in a super cycle? And we we might be in this super cycle, but I'm concerned about saying that outright, that it's a super cycle that's going to last for 10 years. Are commodities fundamentally tight in that we don't, we have more demand than we have supply? Yes, I feel very comfortable with that. But, could things happen like the China lockdowns? China's the biggest buyer of commodities. The lockdowns have been really corrective to the downside for commodities since I think since mid-June we started coming off, right? So a lot of the questions I get is this a dip? Like, can we buy this and then hold it for the next few years? And we feel like, yes, this is the dip. We've had a correction over the summer. We just did a piece called Cruel Summer, and I think that it's been very frustrating for commodities, but we're still up year to date. And we think as we head into 2023, that there will be a lot of wonderful opportunities for commodities for a long time, right, for at least a few years. But as I said, I'm concerned saying super cycle, but in terms of tactical timing, like Fiona said, it makes sense to have like this allocation to commodities. I would argue it should be around 5%, right? Or because a little commodities goes a long way. We are very efficient hedges, but again, I don't know that this is going to be a 10-year super cycle with it just a straight line up. We were just going up for all of last year and for the first part of this year mostly, right? But we've been in a correction right now. And I think that now is, which feels like a dip, and we are expecting to see markets, these commodity markets go higher for the next few years.
Thanks. I've got a question here, Kathy, about gold, which I'm sure is often one that you get as well. How should investors think about gold? Should they think about it separately to a broad commodity exposure? We know the performance of gold has been pretty rubbish over the last 12 months or so, which would surprise some investors because it traditionally was seen as an inflation hedge. So how are you thinking about gold and sort of where it fits in?
And I feel bad because I always bash gold because it doesn't feel like a commodity, right? What are commodities? Are raw materials, right, used in building that are being consumed. But gold, right, it is not really like consumed. I mean, we have jewelry, but gold behaves more like a currency. And that's why the frustration I had when I first joined Invesco and everyone's like, oh, I'm fine for inflation. I've got gold. And I always joke that it's very hard to get gold bugs to part with their gold investment, but it is not an efficient hedge for inflation. The way that the math works out is you would need, I think it's like 35% of your portfolio in gold to hedge your inflation. And last year it didn't work at all, right? Because the 70s were a bit of a different time when gold did work as an inflation hedge. So, but I actually love gold as a safe haven hedge, right? We have a war in Ukraine, right? If you're concerned about geopolitical risk, it makes sense to hold gold. But as an inflation hedge, it doesn't work. And as a commodity, like I said, it's not truly a raw material. So I feel bad that I bash gold all the time, but invest in it for the right reasons.
Yeah, I mean, it's been fascinating to me that the performance has been so poor, given that traditionally we have seen it as an inflation hedge. And I've read and heard and thought about this a lot, and I think there are a number of potential reasons for that. I think arguably the cryptocurrency markets have had some impact there in terms of that asset of last resort or sort of safe haven asset. I think the nature of inflation is different this time. And I think investors have a wider variety of alternatives when it comes to, holding inflation sensitive assets. So,
right. And also the interest rate effect, right? So that's, the
Exactly.
interest rates rise, is impactful, to the negative correlation to gold, right? So interest rates go up, gold goes down. And I feel like that is what is investors are focused on right now. They globally, many central banks raising rates. They're afraid. And then when they raise them, the gold goes down.
Related to gold, Kathy, how should investors think about commodities in a market that we're in now, where the US dollar is trading at near all-time highs? Traditionally, again, strong dollar has not been great for commodities. It's a little different this time.
Right.
Why do you think that is?
I feel like that relationship broke down. So for those who don't know, when commodities are purchased in dollars, so other countries, when they're buying commodities, right, and the dollar is strong, it is very expensive to buy these dollar-based commodities, and that's what we've seen this relationship exist for years. But in this current market rally, that relationship has sort of broken down because, as Fiona, as you mentioned, we have the rising dollar, but also rising commodity prices. So I don't feel that is going to be a concern for the next few years. It may be having an impact right now because the dollar is so strong, but generally we still are bullish commodities even with a strengthening dollar.
Okay, that's great. Maybe got a bit more of a fun final question, which we can both have a go at answering. We've had a question that says, do you have a favourite commodity? So maybe I'll start, and I'm certainly in the first instance going to talk about my favourite commodity, not as an investor, just as a commodity. So I started my career in the livestock market. So I have a very large fondness for the cattle and the lean hog markets. They're markets that are relatively small and often don't get a lot of airtime, but they're where, as I said, where I started my career in commodities and where my love of commodity markets developed. In terms of from an investment perspective, look, I think there will likely be winners and losers, over the following, taking a very long-term view over the following decades, as we move through, the energy transition. Certainly not saying that the petroleum complex is going away anytime soon, but its importance is likely to wane. And I think, the other, my other area of real interest is these, so-called new commodities, which I really do think will become the driving force of, overarching commodity sort of market performance over time. And that, while traditional commodity markets and our ability to invest in them has taken quite a long time to develop, we think about, the S&P GSCI as an investable index has only been around for 30 years. And even prior to that, many futures, derivatives markets in commodities may have been available to hedgers, but weren't necessarily available to investors. So it's taken a reasonably long time to get to the level of sophistication we have in commodity markets today. But I think that next step is really going to happen very, very quickly. And investors can play a really important role in developing those markets, improving the liquidity in those markets, and really, pushing us towards that goal of being able to, really decarbonise and use alternative energy sources. So, Kathy, what's your favourite commodity?
I love that you went back in history, because for my history, I've always done oil, and I love oil, like both WTI and Brent. And being American, I always root for WTI over Brent. But sorry, Fiona, but I think that having gone to OPEC meetings, knowing some of the OPEC oil ministers personally, it is a passion of mine, and I don't think a day ever goes by where I don't read something about the oil industry. It is truly my passion. But now, being an Invesco and covering all commodities, I have to say I'm starting to love the grains again, because I went on a crop tour recently and really understanding like corn and wheat I loved. But right now, my little pet obsession is for diesel fuel, like heating oil, right? So diesel being used in everything, and I feel like the refiners are not are producing a lot of gasoline at the detriment of diesel, and we're very low. So if someone said to me, what would I buy right now? It would probably be diesel, the symbol HO. But I do believe that as investors, one of the most important things is education. And that's why, I wanted to talk to you today. That's why I spent a lot of time on the road educating investors. This is a new asset class for many investors. So educate yourself. And we use commodities in every, all day long, every single day. Like the day in the life is all chock filled with commodities. So I think it's a fun thing to learn about, but also a very important thing for investors to understand and to really give it that chance to have that 5% allocation over the next few years.
Thanks, Kathy. That's great. Well, I think we'll, in the interest of time, we'll wrap up there. Firstly, Kathy, thank you so much. I've really enjoyed talking to you today. Hopefully, the attendees can see how passionate both of us are about the commodity markets, and have been given the opportunity to learn something about a market maybe that they don't know too much about. So with that, Kathy, thank you so much, and I will turn it back to the moderator. Thank you.